recipes for technical trading success in Cook's Kitchen.
Welcome back to Cook's Kitchen, and we're going to do one of my favorite topics, dollar destruction hysteria. I coined this recently, DDH for short. And so here's some of the topics we're going to talk about. It's the new decades-old hysteria, I like to say, because I've been talking about this. I'm an old FX trader, so I've been talking about this for 25 years. And we can look at how the dollar panic has ebbed and flowed ever since we came off the gold standard in 1972, under the 1971, actually, under the Bretton Woods Agreement. We'll talk about oil, inflation, and gold, why it's all relative in FX. And when the euro was introduced in 1999, which is when I became an FX trader, the big theme was, the Chinese are going to go to the euro. They're going to sell their treasuries. Treasuries are going to collapse. The dollar is going to collapse. Well, obviously, it didn't happen in 2000, 2010, or even recently. We'll talk about the national debt and what should a dollar be worth. So I did a Twitter thread on this just last week. So this was, let me take a look here. April 27th, I did this Twitter thread. And so just follow me at Kevin B. Cook on Twitter, and you can find this thread. I highlighted a podcast I just listened to with a financial advisor named Carl Eggers. He is based out of Dallas, and he had a great guest on, a friend of his, Justin Paul, a CFA, to talk about the dollar and what's with the new hysteria about dollar destruction. So we'll go into that Twitter thread a little bit because it's I'll reference it because I made about 10 key points. But it made me think, when was the last time I talked about this topic? And so I went back and looked at some of my past content, and it looks like I did this exactly a year ago on May 4th of 2022. And I titled it The Imploding Dollar. And I used a black backdrop here for the design because it's all doom and gloom. And I talked about how, newsletter writers and YouTubers love to hype the doom and gloom of, look what's going to happen to the dollar. The dollar's collapsing. And fair warning is fine, but their alternatives aren't exactly going to make up for whatever they're screaming about. And usually they're trying to sell you something. So I'm not trying to sell you anything here. I'm just trying to provide some context, some clear thinking, some antidote to the biases. And here's what I wrote about last year. I talked about 3 blinding biases. Number 1 is low complexity thinking. This is a complex issue. And, whenever you're talking about interest rates, inflation, economic growth, debt, there's a lot of moving parts. These are non-linear systems. So you can't just look at one slice of the economic data points and draw conclusions. Economic systems have the most complex nonlinear dynamics. This is what Taleb's Black Swan was all about. And you probably heard me talk about that before. The second blinding bias is low flexibility with economic models. So we look at how things should be, and then we get hit with a black swan, something unprecedented like the Great Financial Crisis, and more recently the pandemic shutdown. These tend to challenge economic and monetary history. There's no rule book necessarily for what you do. Now, I will say that we ended up having to overreact to the pandemic shutdown by flooding the financial system with new dollars, and eventually, that inflation was going to come home to roost, and it did. All right, the third blinding bias is a low grasp of the technology supercycle, and by this I mean, it's hard to see the productivity that happens. An event, inflation was low or non-existent for a decade. It finally showed up, but why was inflation missing for so long? And it has to do with the disruption of technology, exponential productivity, new tools, new efficiency that lowers the cost. I mean, we hold a smartphone in our hand that is like, 1,000 computers of 30 or 40 years ago. All right, let's see if I had anything else good in this in last year's. Well, the agenda of most people selling dollar doom or dollar destruction hysteria is they're selling the crisis and the fear. I said that 5 times to make the point. That's an agenda. I also talked about why it's all relative in FX, and we're going to look at the dollar chart next. I posited that stocks are still the number one way to beat inflation. So we're going to talk about external inflation, versus the rest of the world. What's actually happening with the dollar as it's valued around the world, and then internal inflation. What is our purchasing power for things that seem to be getting out of control, like food and gas and rent, et cetera. So the Fed has made some mistakes, but nobody's perfect, and what I mean by that is that's an extremely difficult job. Like if Congress wanted to take over setting interest rate policy, it would probably be a zoo or a circus. One thing about the Fed is you have a lot of smart economists trying to, and they have access to more research than any of us ever will, trying to put their heads together and come up with a steady policy and not make too big of dramatic moves. Obviously, they erred in keeping policy too light or too dovish for too long, but we'll do. All right, so let's look at a dollar chart. Where have we been? You can find historical dollar charts in a lot of places. I found this good one on macro trends, a nice long-term chart. So this is 43 years, and this gives us a good look at what happened after we came off the gold standard in the 70s. The dollar fell, and then the dollar rallied strongly in the 80s. The dollar got so strong that it wasn't good for anyone. It wasn't good necessarily for Americans because our exports were declining on such a strong dollar. So, the idea that the dollar should be super strong and keep going is kind of silly because, then we're not going to sell as much stuff to the rest of the world. So the Plaza Accord happened in the mid 80s to soften the dollar. It was, central banks got together and said, how can we do this? The dollar comes way down in the 90s. This between 80 and 90 area. And, sometimes when you look at these historical charts, like this one is actually adjust for global inflation, so inflation of other countries. After 9/11, the dollar actually soared. So there was its safe haven aspects, and it actually got up to 120, depending on what version of the index you look at. So here we are, and this goes till 2019. So dollar hovering around 100 on the index. And so, what is the dollar index? Well, since the introduction of the euro in 1999, the dollar basket, which has Japanese yen, British pounds, Swiss francs, and Canadian dollar, Australian dollar it's 98%. I'm sorry, it's 58% weighted to the euro. So really, when you're talking about the dollar index, you're talking about how it's weighted to the euro. Obviously not to the Chinese yuan because they peg it. Okay. All right. Let's go to my Twitter thread and just start looking at some of the points of dollar destruction hysteria. So I acknowledge, yes, inflation has reduced the value of a dollar by 99% since America's youth, right? Like what a penny bought and what a dollar buys now, over 200 years. But that's what happens when an economy grows. So let's just be clear about that. We're talking about an economy that has grown by orders of magnitude, and that's created new wealth. Not just manufacturing, but intellectual property and the development of real estate. The stock market, that's real wealth too. Those are assets, and it's about innovation, infrastructure. I mean, roads, hospitals, schools, and of course, population growth, families. So, one thing I ask people right away is like, when they're all worried about the dollar, do they understand that if the value of their real estate or their business went up, and it's worth more dollars, isn't that a good thing? Isn't that something they want? Is appreciation? So it takes more dollars to buy the home or investment you bought 20 years ago, or the business you built. So one thing that most people, we'll look at another dollar chart right after I read this. The U.S. dollar rallied 50% since the great financial crisis. That's what most people don't realize. Even while we had low interest rates and were supposedly printing trillions of dollars, the dollar went up 50%. Why is that? We'll get to that, but and it was during a period of, we had a debt ceiling debacle in 2011. Debt ceiling is a hot topic, right? We're facing a showdown in Washington again for that. There was a day in August of 2011 when the S&P 500 went down 5% in one day because of, debt ceiling shenanigans in Washington. We survived the pandemic shutdown, and we're surviving the current banking crisis. I mean, the dollar remains a safe haven in just about any environment. Why? Because of at least 5 reasons that all have to do with the stability, depth, and breadth of the U.S. economy. And the dollar is the key to unlock the door to the U.S. economy, right? So we've got stability, depth, and breadth of financial markets, the rule of law, our military, innovation, and then a stable, functioning government. Yes, it's imperfect, but relative to the global stage, investors with capital seek U.S. stability, where you have things like protections for real property and intellectual property rights. So those are secure. So to invest and trade with the U.S. wealth base and innovations, you need U.S. dollars. So let's look at another chart, and then we'll talk about what do I mean by the U.S. wealth base. All right, so this is a monthly view of the dollar index. I'm looking here on TradingView because it just gives me a nice snapshot of it. So this is basically the start of 2015 right here. So this is 2015 where I'm circling, and here is through 20 at least into 2021, right? What did the dollar index do? It just hung out between 90 and 100. Well, that looks pretty stable to me, hanging out between 90 and 100 for 6+ years. During we had a recession scare in 2015, energy companies defaulting. Then 2018 saw a credit spread blowout. Then 2020 is the pandemic shutdown. And then all this stuff happened, and the dollar was stable, right? And then the dollar shoots up to multi-year highs here, above 110. Why? Because we were raising interest rates, and so this just reiterates that in the short run of 6 months to 2 years, currencies, the constant current of making currencies move is interest rate differentials. So because we were raising interest rates much faster than the rest of the world, dollars became more in demand. Okay, so now we're collapsing back to 100. So that's the panic. All right, so let's see. We want to take a look at what do I mean when I talk about the wealth base of the U.S. Well, I did this piece in 2021, why the national debt is irrelevant. And I'll run through a few slides. I'm going to show you how you can access this. In fact, the link is at the end of that Twitter thread where you can watch this video I did in 2021 because it's very instructive about how to think about the debt in terms of all the complex factors that influence it. I'm going to show you a page for the CRFB, which is the Committee for Responsible, the financial budget, basically trying to get America's debt down. They've got some good resources and tools, but I want to skip through this deck a little bit. There's some good stuff in here. So if you get a chance to watch this video, here's a good slide right here. When you see this in the video, you'll see this is about the tax base of the U.S. Right? As wealth rises, there are more tax revenues. And so we can tolerate a higher debt. All right, corporate profits and hopefully taxes keep rising in this trend. All right, so John Rutledge, in 2008 and 2009, I discovered his work. He was an economic advisor for Reagan, but he talked about the total assets of the U.S. economy. And at the time, this is 2009, he was talking about 188 trillion in total U.S. assets, which was over 13 times GDP. So he was already starting the discussion decades ago about when people get worried about the U.S. national debt, they're missing the point about what the wealth base, the total wealth base of the country is in terms of assets. So that was his calculation in 2009. This is March of 2009, 188 trillion, 13 times GDP. So, where can we get an update on that? Well, 2 years ago, the only place I could find an update that made any sense was this Wikipedia page that somebody put together, and they were calculating U.S. assets of 270 trillion, 15 times GDP. So it had grown quite a bit. GDP had grown, but assets had grown faster. Strip out the debts of 146 trillion, which was over 8 times GDP, and we get a net worth, basically a wealth equation, of 124 trillion, 7 times GDP. So unfortunately, no one has updated this page. So I had to do a little homework, like where would we get the data to put these numbers together and then simplify it so we could have a summary paragraph or two, not just tons of spreadsheets. And so what I realized I had to do is I had to go to the Fed and find the Z1 report. So what is the Z1 report? Z1 is something that the Fed does every quarter. It's basically it's financial accounts of the U.S. So it's a scorecard of where we're at, where are all the assets and liabilities. And so you can just Google Z1 and you'll probably get directed to this. And there's just a ton of data here. So it would be great if an economist or a few economists got together and tried to simplify all this data because there's so much here. But let's just look at household net worth. Household net worth, and this is all data as of the end of last year, because this just came out on March 9th for Q4 of 22. Net worth of households and nonprofits together increased almost 3 trillion to 147.7 trillion. That's net worth, right? That's minus the debt. The total assets are 167 trillion. So the liabilities are only 20 trillion. So if you go here, you can see it in lots of visual forms. And in fact, this page I'm looking at, the charts are not interactive, but they are. There's a simple function here where you can access all the charts as interactive. So I just want to glance at some of the visuals here. Here is assets versus liabilities and net worth since the beginning of the century, since the beginning of the 21st century. Pretty interesting, right? I mean, since the great financial crisis, our assets have grown from, let's call it, a trough of 80 trillion to 160, 170 trillion was a peak we hit, but now 167 trillion are the assets. What are the liabilities? Well, there's your 20 trillion in liabilities. This is household net worth again. This is not corporate balance sheets. This is household net worth. And so take away 20 trillion and you get, the solid blue line, which is net worth of 147.7 trillion. Lots of other good charts and data here. Highly recommend taking a look at it. And the graphs, again, it's up and to the right in terms of wealth, right? Let me show you a pie chart that sort of breaks this down. This is from the Brookings Institution. This was from 2018, but it's still useful to talk about. 6 facts about wealth in the United States. They were writing about it because we were going into election season, and they'll probably update it because what's going to happen during election season? The debates are going to be about things like the national debt. At the time, they were looking at 98 trillion in wealth, and that would be net worth, right? Assets minus liabilities, and versus 113 trillion in assets. So if we just look at that and make a comparison of 2018 to the end of 2022, so 4 years, so I just did the math. I wanted to find out what is the debt versus the total assets. So in 2018, debt was 13%. So, the difference between 113 and 98 in 2018 was 13% that debt represented of total assets. In 2022, the last quarter it was 12%, and that's that 20 trillion versus 167. So that's interesting. One thing I need to point out about the Z1 is, I'm talking about this wealth base being, potentially between 250 and 300 trillion. The reason we're not seeing those numbers in the Z1 from the government is because, so here it is right here. So all sectors, U.S. wealth, we'll call that 137 trillion. Well, why isn't that? Well, how does that number compare to the one we saw in 2014 of 270 trillion? Well, what you're not seeing there is that Z1 does not disclose tangible holdings, essentially real estate, owned by the financial sector, state, local, or federal governments, or foreigners. So there's a whole component here missing when we just look at household wealth. I want to go back to the Brookings so you can see the pie of just how wealth is distributed across households. Financial assets are in blue. What's that? That's the stock market, basically. Okay, and then non-financial assets are real estate, home ownership. So that's roughly the way it breaks down is when the stock market's doing great, and those 401ks are high and IRAs, that increases the financial wealth of households. Let's see if there's anything else good here from Brookings. I'll be looking forward to see if they update again before the next election debates. All right, what else do I want to show you here? So, let's go back to why the national debt is irrelevant. Make sure I showed you the good stuff. Okay, so here's the Wilshire 5000. This is a great chart to look at. I'll show you a new one. Basically, the Wilshire 5000, because this is Buffett's concern, right? Is like, what is the percentage? How does the stock market total capitalization compare to the GDP? Should the stock market be 2 times GDP? Well, it seems pretty comfortable there. The great thing about the Wilshire 5000, if you go to stockcharts.com, it's priced as its market capitalization. So this is a daily chart today. It's showing that number 40,747. That's 40 trillion. Okay, so that's the capitalization of stocks. Call it 180% of GDP. Buffett's been talking about that indicator. Like, I remember people asking me about that, 15 years ago, or at least 12 years ago, after we come out of the GFC. And did it matter anymore? Obviously, it doesn't. And then when you look at the wealth base versus U.S. debt of 25 to 30 trillion, you can see that it doesn't matter. So let's go back to some of the points in this Twitter thread. And if we don't get to all of them, I want you to go and find this, because these are my talking points, but I'm happy to debate them. And you can come on Twitter and we can have a discussion about it. So point number 4 here, I ask, what of losing global reserve status? So in over 20 years, the U.S. dollar has gone from 67% of global reserves to 60%. But it makes sense when you look at the rise of the euro. Like the euro, it had a troubled birth and childhood, but it became important, right? And the dollar was down in 2008 because the euro became so important. Oil was $150. The euro was 160, or $1.60 for a euro. That was an extreme. And that's what happens in markets. Things run to extremes, and then cycles, sort of balance out. So right now, the big argument about the, dollar destruction hysteria is, oh my gosh, the Russians and the Chinese are going to deal oil using the Chinese yuan. Isn't that terrible? Well, I mean, it's a global economy. And again, it's all relative. So it's a fraction of the U.S. wealth base versus GDP versus our trade and versus our innovation. And then we remain a safe haven during a lot of it. All right, let's see if anything else good here in this thread. So so let's talk about internal inflation. Obviously, the dollar is not collapsing on the global stage, as I just showed you with charts that, we were 90 to 100 on the index for 6 years during all kinds of crises. Then we go up to 110, and now it's down to 100. It's not collapsing. There is no dollar destruction going on because it's all relative. Everybody needs dollars. The euro is not going to be the only currency. The Chinese have an unfair peg, but we benefit from their economy too. All right. So what about internal inflation? What about food and energy and rent and all this stuff going up? And, how do you beat that? Listen, I've always said you think like an investor. So you're either investing in stocks or real estate as the two biggest winners for, beating inflation in just about any cycle, any environment. I mean, if you have a long-term plan, like I'm not talking about the cycle, like you're going to necessarily beat inflation, over a period of 1 to 3 years, although you can, but you beat it long-term with long-term investments that go through cycles, so, you've got plans and implementation over 10 and 20 years that take you through the cycles, and that's how you beat inflation. So, I say, learn from people like Buffett, Bridgewater, Zell, and Blackstone. By the way, I've been learning more about commercial real estate and investing in multifamily apartments. And I have a newsletter on LinkedIn. If you want to follow that, you can get the link there. All right, so national debt. Okay, yeah. And at the end of this, I give the link to the video about why the national debt is irrelevant. All right, let's see what else I wanted to show you here. So, yeah, and that's where this will take you to this piece. It's on Yahoo. Oh no, this is the one about the imploding dollar. So this is another one. If you want to find that, just search imploding dollar Kevin Cook, and you'll find this article on the panic of the profiteers. All right, let's see what else. Oh, I wanted to show you about, this is the Committee for a Responsible Federal Budget. So if you just go to crfb.org, this is a cool tool. They challenge you, like, can you fix the debt? Their goal is that they want to be fiscally responsible and get the U.S. debt under 100% of GDP by 2033. So they have policies and plans that could do it, but they invite you to try. And because the projection, this is their projection, is that if we don't fix it by 2050, we're going to be, we'll still be at 180%. So this is a good page to come here. I have not played with their simulated game, but that's the tool you're looking at here if you go to crfb.org. All right, let's see what else I wanted to show you here. I think that's about it. We've looked at the charts. We've looked at the hysteria. We've looked at the debt. And, so bottom line, this is a complex discussion, but the big themes are: think about the U.S. wealth base and how, we just keep growing and innovating, and think about why dollars are in demand and will always be in demand because of the depth and liquidity and stability of our financial markets, our legal system, the rule of law, and then innovation. Those are the big themes. All right. Thanks for joining me in Cook's Kitchen, and find that Twitter thread at Kevin B. Cook, and let's talk about it.